And here comes the big showdown. That is going to be the major thing we're going to be looking at this week. The other thing is we're going to be talking about, has it just been a bump in the road, or is that labor market really showing signs? And the last thing is, what are the purchasing managers telling us, and why do we need to pay attention? Those are the three things that yours truly believes has the biggest impact on interest rates this week, and that's why you need to know about them. So let's dive right in. My name is Kevin Weedmark, aka the Mortgage Mouth, coming to you every week with an episode of the week ahead, diving in on what I believe, like I mentioned, are the top three things that we need to keep a lookout on that are going to move interest rates. So let's just dive right in. And as I already mentioned, number one on my list this week is the government shutdown. By Wednesday, we will know if we are going to have a government shutdown, and let's dive in of what that means either way. I think what we're really looking at is if we do get a shutdown, it is going to create uncertainty. So what it's going to do, I think it's going to put the brakes a little bit on the real estate market. However, in times of uncertainty, we typically get movement into treasuries. The other thing that we're going to get is, obviously, it's going to be poor for the economy. If the economy looks like it has the greater potential to struggle, that is going to be good overall for treasuries, right? Because inflation, as we already talked about, it seems to be sitting at the 3%. Nobody really seems to care that it's sitting at 3%. That seems to be the new norm. I think over the long haul, I've already discussed that last week of what impact that is. But I think if we do get a government shutdown, and I think there's a really good possibility we're going to, because it seems like they're pretty far off, I think it's going to be good, decent for interest rates. On the flip side, if we invert it, I think what we're going to do is we're going to see a spike in the market. I think, and when I'm talking about the Dow, the NASDAQ. I think crypto does much better, and I think treasuries get a little bit of a sell-off. So I think that if they avert a government shutdown, because I believe what's going to happen if they do, and they have the ability to avert it, is they're going to have to meet in the middle from where they're already at. And it looks like the GOP just wants to kind of kick the can down the road, not add too much spending, keep spending levels the same. And on the other side, it looks like the Democratic Party, for whatever reasons they gave a lot in the last concession, pulling back a lot of government spending with a lot of their programs. They want to add some of that back in. And if you do add some of those back in, what does it do? Well, it increases the federal budget for the deficit. So that's inflationary, and inflation already running at our new norm, as I like to call it, of 3%. And the long term is not good for interest rates. There's only going to be so low that they can go. The floor is going to be set, and it's not going to have the potential to get any lower than that, because once again, you're only buying treasuries to hedge against inflation. And inflation, if it's sitting at 3%, has the potential to maybe go 5 or 6 very quickly because of policy. You're not going to get traders that want to buy in with the treasury sitting at 3.5%. I mean, there's no reason to be dumping your money into that marketplace, into treasuries, mortgage-backed securities, if you have higher inflation. So to me, it's a really big thing. And the other caveat behind that is, if we do get a government shutdown, data is going to be delayed. So now you're going to have the Fed flying blind. You're going to have traders flying blind as far as what to do with data, meaning the huge jobs. And that's going to be my number two, is if we do get the information released and we do avert a government shutdown, the second thing is going to be jobs. And why did I say, hey, was it just kind of a bump in the road? Because the labor market seems like it's really been struggling. If we look at the last couple non-farm payrolls, they've been adjusted, right? They got adjusted really lower. It was inflated about 250,000 jobs and so on and so forth. But initial jobless claims seems to have recovered over the course of the last month. Maybe the labor market's not doing so poorly. So do we just have a bump in the road for whatever seasonal issue that we had, and now it's already recovered? Or is the labor market really struggling? And I believe Friday's jobs report is going to give a clear indication of that. And if you see that an economy is really struggling, and the labor market is, and initial jobless claims doesn't know what they're talking about, and ADP doesn't really know what they're talking about, because that will be released on Wednesday. You also have JOLTS in there. you're going to see interest rates go lower. However, again, if it's just a bump on the road, it looks like the labor market is beginning to recover. You have obviously inflated inflation. I've been saying that it's sticky. It's not going anywhere. We've been talking about it for years, the mandate to get it to 2%. We've been talking over 2% for inflation for about 4 years now. What is the Fed doing? What are they doing that they can't get it down there, right? With all of their policies and their influence and what they say they can do and so on and so forth, they're obviously not doing the job of getting to their dual mandate. And the reason is because they got us here in the first place. I don't want to get on my soapbox because I can talk about it forever, how much I am dissatisfied with this Fed, but it is what it is. So once again, we got that government shutdown, and hopefully they do avert it. I think interest rates would actually go up if it gets averted, because I think the money then goes into the markets, it goes into crypto, it goes other places. Everyone that would then sit tight, run interest rates up a little bit till we get to the big number on Friday, that non-farm payroll. We'll see some fluctuation, some volatility through the week, but that big number on Friday is going to be massive, and it will really dictate where rates are going in the future. And again, I'm going to say it this way. We get a favorable number for us, we're going to see interest rates probably coming down, because what it would mean is more Fed cuts, because the economy is going down. Inflation doesn't seem to be the biggest concern. However, if that tide is turning, the labor market is recovering, showing signs of life. As we can see, what is the expectation for Friday? They're talking 51,000 jobs. I mean, what a horrible number. Last month we were at 22. They're talking 51. What a joke. But that's where we're at. So, and unemployment's at 4.3. So if you see better numbers there, what's going to happen is you're going to then see everybody go back to the inflation side and say, oh no. And if we actually avert the shutdown and we create more government spending and add to that already inflated federal deficit, it's not going to bode well for treasuries. And I think they're going to be pushed, that 10-year treasury will be pushed up to about 4.3%. We'll be back to where we were about midsummer. So fingers crossed. Once again, look, we never want to see an economy struggle, but there's a couple things that could really go in our favor this week that would do the best for interest rates. And that's what we would like to see. We want to get over this hurdle. We want to stay in that 6%, low 6% range, maybe even crack that 5% on the conventional and jumbo side, so we can get some relief, so we can get some people off the fences, so we can get some stability and just some certainty of where interest rates are sitting. And 6% would be low sixes would be a wonderful new norm for us. So in looking at that 10-year treasury, like I said, if you look at it over the course of the last month, we had that beautiful dip towards the beginning of this month. Things were looking really rosy for us, right? We were in the low sixes. I want to say we were, even hovering in the high fives, only for that to be corrected. And now we're sitting at 4.14. At the beginning of the day, we were almost at 4.2. So we're in this range now, and I don't think we get out of it until we get our data for the week. So that's where we're sitting. And then the last thing we're going to be looking at is PMI, the Pricing Managers Index. As you can see, we have it coming out here on Wednesday. We have ISM manufacturing, and then we also have non-manufacturing on Friday. And what that is the Purchasing Managers Index. And why do traders love it so much? It's because they're right. I mean, basically, they're the boots on the streets. They're the purchasing managers that are real time, can give us real time data as far as what is going on with pricing, what is going on with orders, what is the manufacturing side, and so on and so forth, for services as well as for goods. So it's a good pulse indicator of what's actually happening on the streets, as opposed to waiting for that government data that a lot of people will believe now. Especially when I put out these videos, I get a lot of comments saying, well, what numbers do you believe? Is it the government that you believe? And so on and so forth. So the purchasing managers, once again, tend to be a little bit more, in my opinion, although it doesn't carry as much weight as those big data sets, I think it's wonderful information because it's real time and it's right now and it's within the last week, and it's those purchasing managers that are dealing with it on the right on the front lines. So those are the top 3 things to look at this week. We will know by Wednesday with the government shutdown. Friday is the big daddy non-farm payrolls. But once again, you can see throughout this week, you got JOLTS coming tomorrow. That's job openings. You got ADP on Wednesday. You then have initial jobless claims on Thursday, and then you have non-farm payrolls. And we will get some of that data up until Wednesday. We'll get all of that data. If we do get a government shutdown, we will miss Thursdays and Fridays information. And then once again, you have the Fed and everybody flying blind in times of uncertainty. People tend to put money into treasuries, so that could push those interest rates a little bit lower. All right, y'all. I hope you have a wonderful week. Make sure, once again, you hit that subscription button so you never miss a beat. I'll be coming to you later today for an episode of the Daily Dose, and I'll be coming to you Friday with another Friday wrap up. You need anything, you want to spend time learning this business, talking about a potential purchase, refi, running numbers. I love this stuff. All right, y'all. Have a blessed week. You need anything, you reach out. Talk to you soon. Cheers.